Ladies and gentlemen, good day and welcome to Mahindra Logistics Limited Q2 FY24 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Shogun Jain from Strategic Growth Advisors. Thank you, and over to you, Mr. Jain.
Thank you. Good afternoon, everyone, and thank you for joining us on the Mahindra Logistics Limited Q2 and H1 FY24 earnings conference call. On the call today, we have Mr. Ram Praveen Swaminathan, MD and CEO, Mr. Saurabh Taneja, CFO, and the senior management team of MLL. I hope everyone has had a chance to view the financial results and investor presentation recently posted on the company's website and stock exchanges. We will begin the call with opening remarks from management, followed by an open forum for Q&A. Before we begin, I'd like to point out that some of the statements made during today's call may be forward-looking. A disclaimer to that effect was included in the earnings presentation. I'd like to now invite Ram, MD and CEO of MLL, to make some preliminary remarks. Over to you, Ram.
Thank you, Shogun, and good afternoon, everyone. I hope all of you had a good Dussehra and Vijayadashmi break. I'm of course joined today by several members of our management team, including our new CFO, Saurabh Taneja. And it's having him on board. Saurabh joined us a few weeks ago. He comes to us with significant experience across the finance domain, having worked on the audit and the corporate side, and has worked closely as part of leadership teams in growth-oriented businesses. So we are happy to have him on board, and I'm sure all of you will get a chance to engage with him more in the coming months. I also trust you all have had a chance to view our presentation and financial results, which are available in the stock exchange and our company's website. As I normally do, I'll provide a short update on the external environment, our end markets, performance across our 5 business segments and supply chain and mobility, and some key operational highlights. Finally, I'll discuss our financial performance in Q2 and H1 F24 and kind of elaborate some of our focus areas for the remainder of the year before opening up for questions from all of you. So moving on, I think from macro environment, the first half of the fiscal year has gone fairly well. No notable surprises like in the Indian or global economies. Of course, we've seen continuing geopolitical tensions in Europe and now more recently in the Middle East, but those really have not had any significant, altered economic carry yet. Inflation rate in India has remained high, but has been fairly well managed. Monetary policy has tightened further, resulting in higher bond yields, tighter liquidity, and rising capital costs. Demand for logistics services, as always, is driven through the underlying sectors, and that those continue to change. As you can see, increased digital commerce, growth in consumption, industrial activity, of course, and an increased focus on Make in India. These trends are driving a greater focus on visibility and agility and productivity in supply chains as organizations try to respond to these opportunities. And companies are moving towards integrated logistics solutions, which provide them better productivity across their supply chain. Furthermore, increasing consumer demand from tier 2 and smaller towns requires increased focus on TAT and reliability compared to more conventional urban consumption centers. This, in many ways, is the core of our focus in the supply chain space. And our strategy always has been built around a hypothesis that transition from 12 to 14% GDP level for logistics cost to 8 to 10% as envisaged by the government. Rests with increased focuses and requires increased infrastructure, improve regulatory efficiency, and higher productivity in the way companies and firms operate their supply chain. Our vision of providing integrated solutions is thus predicated really on the third lever, which is to help enterprises manage their supply chains towards higher levels of productivity. And this requires moving away from just providing a bouquet of services to integrating these services using technology, processes, and human capital. So the supply chain becomes more efficient, in its total cost of operations. And that has been at the core of our strategy over the last 2 years. And before I talk about our specific businesses, let me give a quick recap on how our end markets are shaping, at least from our company and our sector's perspective. And let me begin, obviously, the automotive sector. As this year has unfolded, retail sector has embarked on kind of a note of cautious optimism. The first half of the fiscal year has been a continuing period of resilience and recovery, with the total auto retail growing at around 9% year on year. Passenger vehicle retails in the H1 in the first half of the year hit an all-time high of more than 1.8 million vehicles, exceeding the previous record, which was actually set last year, right, it's on 1.7 million vehicles. On a year-on-year basis, that represents approximately a 6% growth. The passenger vehicle industry obviously has continued to grow the last 2 years, which has been evidence both of the recovery post-COVID and the continued the response to the sector's focus on diverse and innovative products and services. On the commercial vehicle side, we have seen some uptick in sentiment across our commercial vehicle customers. In specific niches and segments, we have seen some signs of breakout, but across the board, there has been no big breakout yet. And I think across the industry, we're all looking forward to some kind of some uptick as we come to the end of Shraddh and we come to the beginning of the festive season. The consumer durable industry, kind of a mixed quarter there. Obviously, rising temperatures and slightly weaker monsoon in some parts of the country have led to a rebound in RAC demand. And of course, in segments like, in some specific air conditioning. But demand in the ECD segment, especially lighting and fans, remains kind of fairly weak. Kitchen appliance sector is still growing, though we are seeing a lot of the growth actually at the premium end of the market, right, with the entry-level volumes still being fairly muted. Competitive industry in this market obviously is intense, with many smaller players adopting aggressive strategies, and as commodities have cooled off, there has been a more intense kind of price-led competition in the market. However, structural drivers such as increased construction activity, kind of an uptick in real estate, increased capex, right, and general trend towards premiumization will support growth across this segment, and we are quite optimistic about it as we look at the next couple of years. If you look at the FMCG segment, the rural market was initially expected to rebound to the lower inflation, rising income levels in the beginning of this year. We're not seeing a significant change here in many ways, but we are seeing with our clients a consistent improvement, and we expect the industry will recover through the upcoming liquidity session, the upcoming holiday session, and as liquidity pressures relax and government spending increases with an upcoming election year, we will see a positive move there. On a more positive note for us specifically, I think we have seen a greater expansion of post-GST, distribution restructuring by many of our customers. Most of the logos which we are working with have now started working on expanding the network again. And as they do that, they are becoming more omni-channel in their approach, and this is allowing a faster transition to 3PL providers with stronger technology and integrated distribution capabilities. Compared to a couple of years ago, I think we see a sharp uptick in this, both in terms of bid activity right now, and that's a positive sign across the board. After the substantial impact of inflation in the previous fiscal year, the rural market is showing better signs of recovery this fiscal year. Obviously, many FMCG companies have focused on raising their yields or their prices, as there's been a challenge of increasing raw material costs and frankly some increasing logistics expenses as well over the last couple of years due to the kind of the continuing impact of high fuel prices. Moving on to e-commerce, and I'm not going to talk a lot about the tailwinds in the sector broadly because I think we've talked about it many times. In the recent past, of course, we have seen some slowdown as the post-COVID, the kind of COVID fuel growth has started kind of flattening out. And we've talked about this, I think, both at our calls and probably at the industry level. The big question always has been whether we are starting to see a big rev up in the industry. While we have been continuing to see consolidation in the mid-mile, we have started seeing green shoots this quarter as peak approaches. There has been kind of an uptick in terms of bidding activity and obviously in terms of order intake as well. And these include demand for 3PL, last mile delivery and express services and solutions. And some of these obviously are beyond the upcoming peak itself. We believe we remain very well positioned. We have strong partnerships with customers such as Amazon and Flipkart, as well as very strong growth relationships with other marketplaces and quick commerce companies. From a long-term perspective, the segment remains pretty important for us. India is still underserved from a digital or online perspective, and given the strength of our relations with our network, it remains something which we are excited about and kind of upbeat, and then continue to innovate in terms of offerings and solutions for this market. And finally, just a quick tap of the mobility sector. The domestic air passenger travel obviously has more than doubled over the last several years. And more recently, I think from April to September 23, in the first half of this year, domestic air passenger traffic increased by with 142% to nearly 113 million passengers. Right, so that's a strong uptick. The increased demand for air travel, along with the start of India's festival seasons, is projected to result in record levels of air traffic in the coming quarter. And therefore we have seen strong traction on the B2C airport services business. More importantly for our business, return to work return to office has become far more formal across the board. We are seeing, in addition to BFSI, we are seeing a clear move in several of our IT customers and tech customers towards more pronounced return to work or return to office, and that obviously is something which you can see has resulted in increasing volume and growth for us coming from this business. We remain very well positioned in the enterprise mobility space, right? Probably market leadership across the more than 22% market share across the 7 big cities which we serve. And therefore, we're optimistic that as RTO accelerates, we should see a bit of a hockey stick playing, as we have kind of predicted will happen in the past. Now, let me talk briefly about our individual businesses themselves, and I'll begin obviously with 3PL contract logistics business. The contract logistics business, as you all know, is primarily housed in the MLL standalone entity and includes, of course, our 2x2 joint venture. The business did have a positive quarter. Auto volumes from M&M and others remained robust, while increased order intake on consumer and manufacturing e-commerce meant that we were able to start clawing into the churn we saw in the previous quarter. Overall, our business grew 6% sequentially on a quarter-on-quarter basis. As I mentioned in the earnings call last year, there had been a churn impact, especially from e-commerce more than other segments, as we saw a consolidation of capacity in the mid-mile. And this quarter, we've been able to outstrip that churn with new business, and that's shown up in our sequential velocity of growth, right? And that's been positive. For the quarter, we've had a 3PL contract logistics order intake of over 100 crores on an annual contract value basis, which is our second straight quarter in a row. And that's been important for us after a slightly weak Q3 and Q4 of last year in terms of order intake. We remain optimistic that we should see this consolidating further in the coming quarters. During the quarter, we had some key wins, including a large program with Cummins India to establish their India Logistics Center in Maharashtra. We kind of have started working with J&J Noah for their Western India integrated warehousing and logistics distribution solutions. And some of you may notice we launched a program with Flipkart for providing network linehaul services across their IWIT network. And we also have been selected as a single partner for Ashok Leyland's in-plant logistics services across their 9 plants in India. During the quarter, we also commissioned our new bellwether facility in Bhiwandi, which is a multi-client facility of around 6.5 lakh square feet. It is the largest single block facility as we speak in that part of the country. And construction is on plan in expansions in the Chakan-Talegaon region in Kolkata and Guwahati. Warehousing operations for 3PL alone were around 18.1 million square feet at the end of this quarter. As a matter of note, I think the investor deck also carries specifically our warehousing operations only for the 3PL business, right? And going forward, we have removed reporting warehousing, which includes warehousing views for express and other services. Warehousing for 3PL alone was on 18.1 million square feet at the end of the quarter. Continued focus on cost reduction has resulted in healthy gross margin improvement on a year-on-year basis, and you will see that in our warehousing yields as well, which have been included in the investor deck for your reference. On a sequential basis, margins were impacted a little bit by mix, as you've seen slightly higher amount of transportation in the quarter. Right, some peak-related costs as peaks are coming a bit earlier this year. And foreclosure costs of one of our e-com sites in India, where we kind of foreclosed the site and took an impairment on the assets which are invested at that site. The 2x2 joint venture has continued to ramp up. It's been a positive thing as we have kind of got fleet back on the growth, and it's back on a pathway to profitability, and we expect to see further growth in coming quarters as we kind of look at fleet expansion in that part of the business. So overall, the 3PL business has been had a continuing positive quarter, right, given some of the challenges from an overall market perspective. Moving on to the freight forwarding business, this has been a particularly tough quarter for the forwarding business. The Q2 is a seasonally weak quarter generally, and we continue to see pressure on ocean freight prices and higher levels of competition across the board. In the quarter specifically, we also saw some key customer contracts in telecom, especially those services are providing for the 5G network rollout. Those contracts saw a deferral in their volume which is expected or kind of forecasted for this quarter actually moved significantly. Those will come back to us in Q3 and Q4. They've really been deferred due to customer rollout plans, but that did have a significant impact on quarter-on-quarter revenues right in the second quarter. On the positive side, despite some fairly intense competition, we have managed to hold on to our margin levels in the segment. Gross margin levels continue to trend well, and we are hopeful that and the real focus for us is on getting the volume back. During the quarter, we also commenced commercial operations for air charter services. As you will all recall, we had launched air charter services in Dubai, business based in Dubai in June this year, and we're investing in business development through the quarter. We did start our first charters in September, and we're expecting a further pickup in that business through the second half of the year. So the forwarding business, while it's going through a tough part, largely in great part driven by broader macros, we are focused on driving recovery, and the recovery plan is really focused on volume growth. While we think there is some exposure on downside pricing, that has largely bottomed out, and a big part of the focus is on driving that volume growth, both from large enterprises and mid-sized companies again. Recent conflicts in Europe and of course the Middle East now point towards some increased volatility in cross-border logistics, but we have not yet seen any immediate impact in pricing or in the primary trade lanes we operate. In the coming 2 quarters, we are hoping that we will get back to the higher level of volume growth. Some of the deferral we saw on revenue in the second quarter will flow through in the third and fourth quarter. We have done a bunch of roll out a series of initiatives to increase our account penetration both in large enterprises and mid-sized businesses. We try to deal with some tough industry level macro trends in this business. I'll now move on and talk about the express business, which obviously has been at the heart of our conversation, or has been part of our conversation in the last earnings call as well. We had in the last quarter, we outlined some of the challenges we had as the integration had been impacted, and there have been delays due to multiple factors in the speed and the quality of the integration. During the quarter, we continue to see some challenges, but we saw broader positives as well. On the positive side, we have seen revenue yield being stable. Our realization per kilo across our network has been pretty stable through the quarter, and we've not seen any declines there. On a delivered volume basis, we saw a 3% quarter-on-quarter growth in delivered volume basis. And during the quarter, we signed up new contracts which should have ideally been on 9% growth if that volume had come in fully. That volume, of course, did not come in fully because of timing. We signed several contracts through the quarter, and there's a ramp-up period. We also, through the quarter, added 27 new retail partners and added 12 new customer accounts on the enterprise side. So, we did make some progress in terms of expanding demand generation, though it came in shorter than what we had expected. We have also focused really on increasing our service levels, a challenge which we had during the integration, and we have completed the transition to one physical network and a technology architecture across the entire express business. Despite this, as I said earlier, our volume growth has been lower than what we estimated in the recovery plan, which I commented on last quarter. Some of you might note we had indicated that we had seen a volume drop of around 30-35% through the integration. We have recovered around 7 to 8% of it. We still have a distance to go. Through the quarter, as we focus on service level improvement, we did run our line haul network at higher levels to ensure that service levels were met, and we did that at lower utilization to ensure that service levels were constant or at least were recovered. So operating the network without the volumes which we expected, but at higher levels of operations, did result in an increase in line haul costs, and there's a higher cost overrun because of this, which impacts our earnings during the quarter. At an overall level, our margins declined on the quarter-on-quarter despite higher volume, largely on account of the cost of running a network at a higher level. As we look forward, I think we still believe we are running close to 6 months behind the initially planned transition. Most of the improvement actions we had put in from a back-end operations perspective are now in play, and the focus is on recovering volume growth. So there is the pressure of the engagement on winning back the customers and driving the volume growth, while we continue to enhance service levels and drive the network's growth and yields across the board. And there will be a continued carry of this, as we had mentioned, but we remain focused on trying to get to EBITDA break-even by the end of this year, as has been the aspiration laid out earlier with all of you as well. Moving on to the last mile delivery business, again, a business which has seen an improving quarter despite the intense pricing environment. We have grown 4% year-on-year in the quarter. Underlying volume growth net of pricing impact, because we have seen pricing impact, the underlying volume growth was around 8%. We have continued to grow our distribution as a service business with a focus on niches such as grocery and EV-based delivery services. And that has helped us kind of tighten and improve margins during the quarter on a year-on-year basis. We've also seen similar growth and improvement in Wizard as losses have shrunk year-on-year by more than 40%. And we're on a good path in terms of earnings recovery there. Overall, the immediate focus has been on sustaining and improving gross margin with a broader focus on growth. We are in the process of launching our ONDC partnership, which is the partnership with the ONDC, which for last mile delivery, which we estimate will go live this quarter. In the upcoming quarter, we hope to complete the second tranche of investment in Wizard, which will make us a majority company and will consolidate the business. That acquisition will be contingent to appropriate closure of terms which we have signed with Wizard's promoters and other regulatory filings and requirements. I'll now lastly comment on the mobility business. Our mobility business is pretty well positioned as we operate on 6,000 off cabs in nearly 14 cities with a network of around 350 business partners. We have shown strong growth in ETMS volumes and B2C services across both. And a big part of the growth has been, as we envisaged earlier, that as return to office would happen, we would get better growth. But we've also seen a stronger level of new client acquisition on the ETMS side and a renewed focus on what we call city to airport, which supplements the airport to city services. We reported a PAT positive quarter for Q2 FY24, and we are on track to remain to be PAT positive for the full year, as we had indicated earlier. Since the Meru acquisition, through volume growth and operational synergies, we have been able to move that business from being a very high loss-making business at the time of acquisition to become profitable on a consolidated basis, reflecting our continued focus on integration and synergies across our portfolio. Before I talk about consolidated numbers, I'll cover the specific components. MLL standalone, which largely hosts a 3PL business. Revenue for Q2 FY24 was 1,136 crores compared to 1,195 crores in Q2 FY23. PAT for the quarter was 19 crores as compared to 11 crores in Q2 F23. Right, revenue grew sequentially compared to Q1 F24. Profits declined marginally, sequentially due to as I said, specific elements like the mix moving as well as some one-time charges for the quarter. Lots and the freight forwarding business. Revenue for Q2 F24 was rupees 53 crores, down 50% compared to rupees 106 crores in the same quarter for the last year. The company was at break-even level with a PAT of 0.1 crores compared to a PAT of 4 crores for the corresponding quarter last year. The express business reported a quarter of a revenue of around 87 crores for the quarter. That was impact that largely reflected the consolidated impact of both the 3PL, the FY24 MLL business and the Rivigo business. Overall revenue for express grew by 68% on the back of that combination. As I said earlier on, I outlined the reasons for our earnings hits, and we reported a profit after tax loss, a loss after tax of 35 crores for Q2 F24, which compared to around 31 crores in the prior quarter. Mobility business revenue in Q2 F24 was rupees 86 crores compared to rupees 22 crores in the same quarter last year. That growth is a function of both underlying market growth as well as the impact of the transfer of the enterprise mobility business from MLL to MLL mobility, which happened in the second half of F22-23. As I said earlier, we reported a profitable quarter with a PAT of around 1 crore for Q2 F24 compared to a loss of 3 crores for the corresponding quarter last year. Wizard, and I'm added as just commenting on this as a matter of significance. Revenue for the quarter was around 31 crores, that's compared to rupees 33 crores last year. PAT loss shrunk substantially compared to a loss of 1.7 crores in Q2 F23. We had a PAT loss of around 0.4 crores. So we are close to break-even, which we hope to achieve by the exit of this year. The 2x2 business, which largely serves the 3PL business, has done well, and the division made a profit of rupees 1 crore in the quarter compared to a loss of 1.1 crores for the corresponding quarter last year. I'll now move on to consolidated performance for the quarter. Revenue for Q2 F24 increased by 3% on an overall consolidated basis to 1,365 crores, and up sequentially by 6%. Revenue from the warehousing segment was around 256 crores for Q2 F24. Supply chain management includes our 3PL and network services businesses, contributed around 94% of overall revenue, while the mobility business has contributed to 6% of overall revenue for Q2. Gross margin at a fully consolidated basis stood at 9.2% for Q2 F24 compared to 9.7% in the same quarter last year. However, without the impact of the MESPL business, the gross margin was around 11.2% and 150 basis points improvement on a comparable basis to Q2 of F23. EBITDA for the quarter stood at rupees 54 crores, down from rupees 68 crores in Q2 F24. This again saw the consolidation impact of the consolidation from Rivigo. Without the impact of that consolidation, EBITDA grew on year-on-year basis. PBT on a fully consolidated basis is down to 8 crores, a loss of 8 crores in Q2 F24, and we reported a loss of rupees 16 crores for the quarter, largely on account of the carry of the network expansion in MESPL. Excluding the MESPL business, of course, the profit grew in most parts of the business. Before I close out, a few other operational highlights. As I said earlier, construction of new multi-client BTS facilities is on at Chakan, Talegaon, Kolkata, and Guwahati. These will collectively add on 2.3 million square feet of multi-client, platinum or platinum certified warehousing capacity in the next 15 months. We have further continued to consult our green logistics portfolio. Our EV service today has nearly 1,600 vehicles, and we have under 250 passenger vehicles in the mobility fleet. We have operated nearly 28 million green kilometers to date at the end of Q2 of this year. In addition, nearly 40% of our last mile and mobility fleets are also CNG operated, operated on CNG in line with our commitment to sustainable transportation and logistics. We today have over 3.3 million square feet of IGBC or LEED certified warehousing as we continue to grow our sustainable warehousing portfolio, and almost all of that is carbon neutral or energy neutral. Our One Carbon program focuses on developing our client partnerships and supporting their energy transition. This is a digital platform which is fully integrated with the rest of our technology stacks and provides customers online measurement of their carbon footprint. And we continue to expand and bring more customers online. During the quarter, we also certified as a great place to work again, reaffirming our commitment to creating a performance-driven and inclusive culture. And during the end of the quarter, we recently launched an initiative called Deliver Happiness to support and recognize delivery associates across the entire logistics industry for their efforts during the upcoming festive season. Before I open the floor, let me just quickly summarize how I think we stand today and our focus for the rest of the year. Our core 3PL contract logistics business is in positive momentum with improving performance at 2x2 Logistics. We remain positive with the upcoming festive season despite some cost inflation trends there. The mobility business has now completed the turnaround, which we had indicated we'd do by the end of this financial year. And at the time of the Meru acquisition, we had indicated we'd be able to make the combined business. We estimated the combined business would be profitable at the end of FY23-24, and we remain on track to deliver that integration and synergy value. The last mile business is on an improvement momentum, and we continue to believe in an electric or a green future for this segment. Today, we operate India's largest EV cargo provider, and we can hope to continue to accelerate this. Contingent to the acquisition of majority ownership in Wizard, we'll then start working on accelerated synergy opportunities between the MLL last mile delivery business and the Wizard business, and we believe that should further improve earnings across that segment. Our key challenges today clearly are at large and the express business. As we look at the rest of the year, the focus for us is to get volume growth back. We have put in actions on service level improvements on MESPL, and we now believe that the offering and the network are in good shape, and we have to work closely with our customers to get the volume back. And similarly, we are working on several initiatives to drive volume growth in the forwarding segment as well. With this, let me open up the floor for questions and answers. And I'll hand it back to the moderator.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take the first question from the line of Alok Deora from Motilal Oswal. Please go ahead.
Hi, good afternoon. So, sir, I had a couple of questions. First one on MLL Express. So we have seen the quarter-on-quarter there has been marginal increase in the revenues, but the profitability has gone down quite. The loss has increased further. So what's our view here? Because this is kind of the festive season we have entered now, where volumes are expected to be on the higher side. Then again, it could be slightly muted. So this profitability trajectory, if you could just highlight here, because earlier in the last call we had mentioned about a break even by mid-third quarter. So how are we looking at it, this segment now?
Sure, Alok. Is there any other question, Alok? I can take them together then.
Yeah. So this was on the express side. Second was on MLL standalone as well. If you just look at the EBITDA margin on MLL standalone, that has also come down on a QOQ basis. So just your thoughts on that.
Sure. So let me do the first one first, Alok, and because that's a question probably others have as well. So as I mentioned earlier, compared to Q1 of last year, we have invested in getting our service levels back substantially, Alok. We did see a degradation in our net service levels in the quarter. And getting service levels back in our business is really a big function of reducing tax or turnaround times for our customers. And to reduce our turnaround times, we had to actually run the vehicles more consistently and more regularly, even if the load was not there, right? Because for the customers who do give us load, we have big commitments on tax. And so even if we don't get load, we still have to run the vehicles up substantially. And therefore, that's kind of what is the story of Q2. While we did get the service level up, right, we had to obviously invest more in that period, right, to run those vehicles, and that resulted in a carrying cost with transportation costs going up substantially, right, and unfortunately the volume which you envisaged in the quarter did not happen, and that was the problem. So if you see our contribution margins are still positive, but you will note that our contribution margins actually declined quarter on quarter, but reflecting that the impact of the higher transportation costs without adequate volume there. Now, many lanes we actually ran at substantially lower levels. Now, what are we doing to fix that? I think, as I mentioned, our first step, and the playbook is still the same, Alok. I think, which I mentioned earlier, the first step is to get back to an EBITDA breakeven. We are around 30% off on volume to get to an EBITDA level. The gap has shrunk. It was 35% at the end of last quarter. It's around 27% now. So our focus is to get the volume back. As the volume comes back, Alok, the transportation costs will not go up, right? Because the vehicles are running at lower utilization now, right? In a large part of our network is running less than 70% utilization. So as the volume comes back, utilization will go up. Transportation costs will not go up linearly with the revenue and margin growth. And so the big part of our focus really is to get that volume back, right? We had hoped to be, I'll be honest, we had hoped to be at a closer point at the end of the second quarter. The gap should have been lower. That's kind of what we had given as guidance or indications earlier as well, Alok. We are running a little bit behind on that volume growth. We are very focused on it, and I think the basis of what I'm seeing right now and what we see in the market, with some festive happening and some other things which are happening in our own service levels getting better. And I hope we're hoping that we will be able to get to a point of EBITDA breakeven by the end of this year. That requires us to recover volume around 20-25% over the next 5 months or 6.5 months, which is roughly 4 to 5% month-on-month growth, right? And some part of that is actually a large part of that is getting customers who had dropped their share of business with us back in fold. So we have specific customer programs focused on getting that volume back. But as I said earlier on, we are running behind the 9 ball here a little bit. But a lot of work is there. We have fairly high confidence that we will be able to get to that point by the end of the quarter. Right. So that's my comment on the express business. Apart from that, I think the express business has not seen any significant change. We did see an increase in, we also saw an impact in the profits because of a higher level of provision on receivables. As you know, we inherited some part of the receivables as part of the acquisition, and we have taken prudent as we get closer to the period of completing our acquisition accounting. We have taken a stronger look at the numbers there and taken some prudent action there in terms of our depreciation level. Now going to your other question, which is on the EBITDA level, I think, and I'll make some general comments there, and because Saurabh, if he wants to add anything as well there. But I think on a quarter-on-quarter basis, EBITDA did come down in the standalone entity. But if you look at it year-on-year basis, we actually did show an improvement. That impact largely on a quarter-on-quarter basis is a couple of things there, Alok. One has been the mix movement. I think as you have seen, warehousing revenues were flat to down on a sequential basis, and therefore we saw an uptick in transportation revenues for the quarter, and that meant that we did see that impact right affecting our EBITDA margins on the standalone basis compared to the sequential quarter. We also had a one-time impairment of some fixed assets some assets. We shut down a fulfillment center in the western part of India as part of a customer consolidation, and that had an impact of approximately 20 basis points of EBITDA, 20 to 25 basis points of EBITDA, and the rest of it largely was, for the large part, a mixed level issue. I think the more relevant thing actually is obviously a quarter-on-quarter, year-on-year comparison, where our EBITDA compared to last year, on flattish income, or incomes are slightly down. On the standalone entity grew from 64 crores to 64.3 crores to 74 crores for the quarter. That's in performance, and similarly, if you see the first half of the year, standalone EBITDA grew from 127.6 crores to 157.2, which is a 19% year-on-year growth on the back of around 4%, actually a 3 to 4% decline in revenue. Then we also see, Saurabh, if you want to add something, otherwise we can go to the next question.
Thank you, Ram. I think you've covered it well. Nothing to add from my side.
Yeah, thanks for the elaborate answer. Just a last point. So MLL Express, we are looking at a 5% volume growth every month, but when we speak to other industry players, the express market for the full year, they're not talking more than even a 10% sort of a volume growth. And so, I mean, this 24 crore sort of a loss in the EBITDA, which we are doing in the current run rate kind of a scenario. I mean, if these volumes don't come through, this could kind of, be a little extended till the mid next year also.
So that is it. So obviously, I think it's math, right? I won't deny. I mean, so it's math, and the math is exactly as you pointed out. I think our confidence. So you're right. I think if the volume doesn't come in, there is obviously a risk that this is going to be extended. We have done, while there are options of further cost optimization, volume is the big driver. Now, I also concur with your other comment that at an industry level, there has been a bit of softness on express, and therefore, generally, industry growth is now in the mid-teens, early to mid-teen levels. I think what's important from our perspective, Alok, is to kind of see where the volume growth is going to come from. And for us, a big challenge really is the fact that the decline which we saw in volume, we did see a 35% drop in volume on the back of the integration. And that's all. Most of the customers have not stopped trading with us. Many of those customers are actually trading with us. They're also customers of ours in the third-party logistics business. And therefore, the key thing for us is to win customers back. Right? These are accounts that are already trading with us. So we're not looking at new account expansions. For new account expansions, we are only looking at, we are hoping to acquire only in roughly the same level at which the industry growth is pegged at. For us, the key thing, Alok, is to get back the customers who kind of drop their share of business with us. Now, that's why we are confident that we will be able to get that kind of volume growth. And it won't necessarily happen 5% in month on month. Some months will be higher, some months will be lower, but that's kind of what we are targeting to accomplish. But you're mathematically right. If you're not able to deliver that, then there will be an extension to this turnaround.
Got it. Thank you, sir, and all the best. Thank you.
Thank you. We'll take the next question from the line of Namit Arora from InGrowth Capital. Please go ahead.
Yes, thank you for the opportunity. I have two questions, and they're sort of related. I would be very grateful for your thoughts on, firstly, the organic opportunity versus inorganic pursuits, and secondly, the domestic India opportunity versus your international initiatives. That is sort of one strand of question. The second question is, any learnings as an institution from the Rivigo acquisition and other acquisitions and other key takeaways? And thirdly, how are you insulating or managing management time and bandwidth in the turnaround of Rivigo so that you are able to do justice to the organic opportunity? Thank you very much.
Namit, thank you for that question. Always good to get questions from you. So let me try and get through that in some order. I think the organic opportunities versus inorganic opportunities, I think it's a good question. And frankly, from our perspective right now, as I mentioned earlier, we are not really out there in the market looking for any further inorganics. Right. So first, I just want to clarify that we had always laid out 3-4 years ago that as an integrated services provider, we are looking at 4 main services, right? Third-party contract logistics, freight forwarding, cross-border, there's a B2B express and last mile. And today we've got the decks in some way set on all of them. So there's really no focus on further inorganics in terms of our attention and energy. I can't say there will be inbound interest to us, but there's no outbound interest from us. So it's a very straightforward perspective on that. In terms of domestic and international, I tend to look at the international business. For the forwarding business, we look at the international business as an important part of that story. Because as you know, a substantial amount of trade into India does not originate in India. The commercial agreements are actually done out country. And therefore, I think a large part of the international operation for the forwarding business is the need to have, right? But we are doing it cautiously. We're not throwing the kitchen sink at it. And therefore, we're waiting for each other to stabilize. I had mentioned last quarter that we are looking at doing Europe, for example, this year. But given the slowdown and some of the international tensions in the Middle East and kind of continuing challenges in Europe, we, for example, have slowed that rollout. So it is a wait and watch, learn kind of process, and therefore I see international more as a set of pilots for the business. Back in 2021, we did pilots in forwarding, in express, in last mile, right, in electric vehicle cargo to establish the business model's efficacy. And we are doing the same thing on the international side today. So it's not a significant amount of, it is not intended to be a significant investment at this stage. Though from a longer term perspective, I think there are broader opportunities which exist globally, but they only happen after we have cemented a strong domestic business, which remains our priority for us. Okay. In terms of acquisitions and our takeaways, obviously I think all acquisitions are the same in some ways and they're different in some ways. So it's hard to put a specific one size fits all approach. We do have a playbook in the company, both in Mahindra Logistics, and we take some support from our parent as well from M&M as well on this. If you look at our acquisitions, several of them have gone well. I think the Lords forwarding acquisition, barring the current macro impact, has gone well. We've seen strong earnings, working capital, and brand value, and good integration with the core contract logistics business. Similarly, I think if you look at what's happened with the mobility acquisition of Meru, we've been on track with what we told the street. We told all of you that we expect in 18 months we'll get this back on track. Meru at one time was losing 2021 lost. Had a profit, had a PAT loss of 19 crores on revenue of around 40. Right, and we kind of said that we are confident through synergies and build outs that we'll be able to kind of fix that, and we have. Right, we are now at a point where we are confident about the profit runway there. So those acquisitions have gone well. The Wizard, the business, while it's an associate of ours, there's a lot of collaborative work which have happened between businesses in the way we look at different things and learnings and synergies on an arm's length basis. So there are acquisitions. Some of the acquisitions have gone really well. Obviously, I think on the Rivigo acquisition, we've actually taken those learnings and put it into the MASPL acquisition as well. And I think there are some learnings for us clearly around network integration, around culture management, and those are learnings which you obviously are cementing. As I said, to the earlier part of your question, on organic versus inorganic, we're not really out there in the inorganic space. So as we complete the MASPL integration consolidation, we will further sit back and take those learnings into our playbook. And they are good learnings. The Rivigo acquisition is a first largest one which we did. The earlier acquisitions are smaller and probably we had the benefit of scale or lack of it at the pace at which we did it. But the acquisitions still, these are 7-9 year business models, right? When we lay out these acquisitions, the network acquisition of RSPL was not based on a two quarter business case. It was built on a 7 to 9 year business case as we shared with our board and other stakeholders. And while we are behind, we continue to believe that the longer term business case is not adulterated in any form. If you look at other companies who are building networks, there are companies which are losing money after 11, 12 years of building a network. Right? The Rivigo acquisition has given us probably a 6 to 7 year head start in that process. There is a bit of a burn. It doesn't take away the fact that we've not executed very well. We are putting measures to fix that. But those learnings will be consolidated, obviously, over a period of time. In terms of insulating management bandwidth, I think the way I look at it, Namit, is that we really run a multi-business unit structure. There are, each of these business units is fairly engaged and self-contained from a sales operations perspective. It also has, for the large part, except for technology and brand and marketing, except for those two areas, and legal. Even in other areas, we have dedicated teams for each of the businesses. So the businesses are fairly self-contained in that form, right? And the 3PL business leads the solutions for it, but it then pulls in the other parts of the other businesses as required. So it's a very well-structured, self-contained business. Each of the businesses has general managers or leaders or business leaders, and many of them are on this call. And they all have their individual pieces to do. And so the management focus is a bifocal one. There are individual heads for each of the businesses, right, who are focused on delivering to their targets. I think, as you've seen in several parts of our businesses that we have driven improvement, those are teams which are delivering ahead of the curve, right, and getting there. And obviously, at the MLL group level, we are focused really more, which largely is our core functions, the technology, marketing, finance, legal, myself. A lot of us are enterprise transformation. We are focused obviously on providing support to the individual businesses where they're running well on track, and providing additional support and involvement for the businesses where they are not, right? And so today, some amount of higher bandwidth obviously goes on the express business, as a large part of our functional resources are kind of engaged on working with them, whether it's ops excellence, whether it's transportation, and I forgot to mention them earlier, but they're all focused on supporting the businesses. So that's kind of the way we run the thing, and therefore it's not a significant bandwidth challenge. We get asked this question at times, obviously not on earnings calls and in smaller group meetings as well. It's a business of multiple services. It's predicated on one or few individuals, and it's really not. It's a fairly elaborate team, and as you can see, many of our businesses are now at sweet spots in terms of getting earnings up and driving that value. So it's something there's a model which I have a fairly high level of confidence in. This is logistics is a very hyperlocal business in the end, and therefore you need to have empowered teams which are charged and are highly accountable and responsible to deliver results. Right? Centralization is not a great approach for us. So we believe the structure works, and on the large part, I think it's working for us. I hope that answered the 3 questions, but
no, it does very, very comprehensively. So I really appreciate your very detailed and candid perspectives on all my questions, and all the very best to the entire team. Thank you, sir.
Thank you. Ladies and gentlemen, in order to ensure that the management will be able to address questions from all participants in the conference, please limit your questions to 2 per participant. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Jainam Shah from Equirus Securities Private Limited. Please go ahead.
Yeah, hi sir, thanks for the opportunity. Sir, there has been always an industry commentary that express business and contract logistics 3PL SCM business will have some synergy benefits. So as we've acquired the Rivigo, we might be giving our express part of that 3PL business to some other counterparties. How has been the things has moved for this part of the business in last 1 year, and how we are looking at apart from external volume growth, has there been any growth that came from the internally from this kind of synergies?
Yeah, so thank you, so there's not too much of so first question, I think there isn't a huge insourcing lift. I think we had back in 2021 we had started our own express services internally, and therefore we were obviously serving some of the. We didn't have a high market share, but we were serving a fair number of our express requirements locally in-house. Right, and therefore the process of insourcing had already started, and before we did the MESL acquisition, there wasn't a huge amount of outsourcing. We do use outsourcing partners on the express side, but that's a lane-specific or geography-specific strategy, because at a state level, in a local intrastate level, for example, we may not always have the depth which other players have in inbound geographies, and therefore we co-load with partners which are there. But I don't see a significant amount in insourcing benefit because we were doing it in-house, and that's kind of what we transferred. What we think is a larger benefit which is there is, I think when you look at supply chains, they are, they comprise 3-4 different things. They always comprise, full truckload volumes, right? They do comprise warehousing, but there is also a substantial part truckload and time-defined part truckload movement which happens. And as India expands consumption to tier 2 and tier 3 cities, right, and road infrastructure gets better, the propensity to do more part truckload will increase. Because companies today are often moving full truckload because they find the transportation is unreliable, it takes a lot of time, they think a full truckload gives them better security. But as infrastructure gets better and they go to smaller demand consumption points, there will be no choice but to increase part truckload. And therefore, having a strong express capability is, in our view, essential to the long-term view of the Indian logistics space. And therefore, the synergy will come as you provide more integrated warehousing and distribution services. So today, if you look at, as an example, for Dr. Reddy's in northern India, we run a fulfillment center across the country. And if you look at what we do, we bring in drugs coming from different Dr. Reddy's plants into that FC. And we run that fulfillment center, which is STEM controlled. And from that FC, we use the 3PL business uses its own trucks for full truckload. It uses the express business for part truckload, and it uses some air partners for air movement. So those are the kind of solutions which you can do more and more of because we have stronger our own express capability, especially one which is highly evolved in terms of time-defined deliveries. And that's so the synergy over a period of time you should see, and we are hoping, we believe in the exercise, is the ability to sell more integrated solutions for our clients and be able to win more business with our clients as we provide them better productivity across the supply chain. And today our customers don't have to work with one company for express, another company for warehousing, a third company for full truckload. And we are seeing that shift happening. I think you see some of our wins which we have been reporting. You will see more and more wins moving towards integrated warehousing and distribution, where express is a very important part.
Got it, sir. And sir, just on one data point question. So how much of the SCM or consolidated revenue has came from the parent group?
From the?
For this quarter.
I think it's around 53%, but we will send you we'll send you a more specific number, Janet. I think it's around 53% for the quarter.
And this
for the 3PL contract logistics.
Got it, sir. Thank you so much.
Thank you. We'll take the next question from the line of Abhishek from Dolat Capital. Please go ahead.
Thanks for opportunity. Sir, in 3PL business, how much mix for auto versus non-auto segment?
Yes, I think auto is around 68% for the quarter. That includes the Mahindra businesses and the non-Mahindra businesses. Auto and manufacturing is around 70%, close to 70%.
That is for the 3PL business only, no?
Yeah, for the contract logistics business.
Okay. And in non-auto segment, how much is from the e-commerce and consumer durable?
So, I think we generally don't report that specifically every quarter, but I would say at a bellwether level, it's probably half and half. Right? I think the consumer business is around 15% and 14%, and the e-commerce business, excluding last mile delivery, is around 17-18%.
Okay. And sir, in the 3PL industry, penetration is quite low in India. That is around 5% versus global average of 10%. And expect 20 to 30% CAGR growth going ahead. And you have also a good market share of around 6 to 7%. So what is your plan to gain market share in the fast-growing industry, sir?
No, I think all the statistics you have provided are all accurate. The 3PL business, third-party logistics business is in India is under-penetrated. But the definition also is a mixed bag. When we look at the market, the challenge which we have even in India is that, what do the third-party logistics providers do? They essentially provide productivity by integrating different service lines across, right, for a customer. And in India, the challenges in 3PL penetration has really been, the high level of, fragmentation in the industry and the lack of regulation. And because of that, delivery quality and capability has always been a problem. And therefore, the Indian industry has always depended on asset owners and aggregators rather than third-party logistics companies. Now, this is slowly shifting. I think I made post-GST, there was a big expectation that will change at a very rapid pace. That change has not happened at the pace everybody expected because companies found it difficult to move incumbent networks out completely. And across India, there's a lot of variability in the ability of us to provide service across India. So a company cannot run, with its own trucking, with direct trucking in one state, with 3PL in a second state, with a CFA in a third state. Companies obviously want to have common fulfillment models, right? So that actually, those have been challenges for companies in transitioning towards a more 3PL model. But as I mentioned in my opening comments, I think as we are seeing today, what we are seeing is companies, we are seeing far greater consolidation. As companies are laying out newer networks, there are the three big challenges they are looking at. One is how do they bring down the cost of the supply chain by reducing waste. Right? It's not that any company in India is buy at purchase price. It's normally the waste in the supply chain which has to be eliminated. The second one is companies are struggling to establish supply chains that are multimodal, right? Because they have to have multiple modes of transportation, different kinds of warehousing there. And the third thing is that demand inherently has become omni-channel. It's not just one traditional network. It is modern retail. It's online. And therefore, companies have far greater complexity in their supply chain. And that is driving a greater transition towards 3PL. So while I would not specifically hold the candle to a 25% CAGR going forward. Over the next few years, we should start seeing that 5 to 6% penetration of 3PL going to around 9 to 10%, and hopefully within that space as well, a greater formalization. Because even inside the 3PL space, if you see it, at 6%, 7% market share, we are probably the largest or the strongest position there. Because even inside 3PL, it's very fragmented with a lot of smaller players, and hopefully that will actually see some better consolidation as well.
Thanks, sir. Thanks for your detailed answer. That's all from my side.
Thank you. The next question is from the line of Vikram Suryavanshi from Phillip Capital. Please go ahead. Mr. Suryavanshi, I have unmuted your line. Kindly proceed.
Yeah, thank you. Sir, can you highlight about absolute revenue in terms of warehousing? We have given per square foot, but in terms of absolute revenue and growth, and how is the outlook?
Yeah, I think revenue from warehousing services for the quarter was around 246 crores. I think I mentioned that it might come in. And that's largely on the 3PL side. As you know, we do not count the, we use warehousing for express and for last mile also, but we don't count it as warehousing revenue. Right, so the revenue from warehousing and solutions around 246 crores. I'll give a more specific confirmed number. It's on 246 crores in the quarter.
Got it. Yeah. Thank you, sir. Yeah.
Thank you. We'll take the next question from the line of Krupa Shankar NJ from Avendus Spark. Please go ahead.
Hi, good afternoon, and thank you for the opportunity. One question on the mobility business, Ram. On the return to work, I think what I was looking at broadly is that, FY19, this segment was generating about 385 crores of revenue. And now you add Meru's overall operations on top of that. Assuming it comes back to the levels of FY19, can we expect, somewhere a 25% higher number vis-a-vis FY19 numbers in FY25?
Hi, Kripa. Good to hear the question. But so just to put some context, I think in 2018-19, which is a peak year for the mobility business, we had 370 crores of revenue and around 4% PAT in the MLL business. And at that time, I think corresponding revenues in the Meru business was around 55 crores. On an accounting basis, platform revenues were probably been higher. The business was reporting a loss, so So consolidated, this is a revenue levels have been on 420 to 430 crores, right? And obviously with return to work happening now, we should start, and underlying inflation per kilometer prices, your hypothesis is right. Right? If we get to full volume at a pre-COVID level, this is what we have been saying as well, Krupa, you know this, that we do expect a hockey stick playing out in mobility. And so I'm cautious about calling out a timing for the hockey stick. But we are, I think, definitely seeing a convergence or the start of the hockey stick now. Right? How quickly it ramps up is something which is hard to predict because there are some fundamental shifts also happening in terms of work from home. It's not like even though RTO is becoming more significant, I think work from home is also a reality. And therefore there is probably, at least in the long term, there's probably going to be a 30-35% reduction in volume happening because of work from home. Right? So if you take that index, you'll reduce it by 20-25% because of the long-term work from home pattern and do a kind of an organic CAGR growth, you'll probably land up at 450-500 crore number at least. Right. But that's a point, that's an end point. The question has always been, Kripa, we've said this earlier on also, that's an end point which we do see clearly. The question for us is, how do we kind of get the ramp up and the shape of the hockey stick?
Got it.
I don't know if it's going to be 24, 25, but I'm sure it will happen at some point.
Sure. Second question was on the freight forwarding business. So I did see that, the profitability has weakened quite considerably out here. Any one-offs you want to call or any commentary on profitability coming back to at least on a EBITDA basis at around 3% levels in the second half?
So to be honest, Kripa, this is, as you know, this is just a volume play. I think if you look at the details of it, there is not, it's really been a drop in gross margin, dropping down to EBITDA and dropping down to PAT. Right? Gross margin percentages actually have held for the large part. I won't call out a specific improvement because it's a bit of a moving number, but percentage levels of gross margin have generally held. The question really has been the volume shrinkage, right? If you look at it, we are roughly down 50% on revenue compared to last year. If that revenue had held and we added 56 crores more of revenue with 10.5 to 11% gross margin, would have probably been at the same 4 crore PAT level. Right? So it's really just a straight volume play, and the key thing for us is to get the volume play back. While we are maintaining discipline in investing in the business as well, right? We don't want to shrink our long-term investments in the business because this correction will happen. It is an industry macro thing. So volumes will, I think I have great confidence in our organization, our sales teams there. And I'm confident the volumes will come back over the next couple of quarters. It will take probably a bit more for it to further accelerate itself, but it's just a volume.
Got it, Ram. Thank you and all the best.
Thanks, Kripa. Take care.
Thank you. The next question is from the line of Alok Deshpande from Nuvama Institutional Equities. Please go ahead.
Hi, Alok.
Hi, Ram. Good afternoon. Two questions from my side. First, on the express business. So the OPEX cost that we have, I'm simply going by the difference between revenue and EBITDA here. This OPEX of about 110, 112 crores. Now, as the revenue ramps up, can we consider this as an absolute sort of floor in terms of, is there any chance of this OPEX going down by any chance? Maybe due to any one-offs or anything of the sort in Q2, or you see this number going up?
I want to finish the questions, Alok, and I'll answer all of them together, just in the interest of time.
Okay. And the second question is on the core business. I think somebody did ask this a little earlier in the call. I just wanted to get some clarity on this EBITDA margin going down in the core business or the standalone business. In the last couple of quarters, this Q4 and Q1, we have seen that number around 8% or so. So as we enter festive season, do you see that margins going up in the second half and more closer to 8%, or what's your outlook on that?
Sure. So I think So look, I'll take the first one first, the express side of the business. So I think to your question whether our total costs are going to remain at that 111 crore level, which is, I guess, the way you're computed that you've kind of taken the EBITDA loss and the revenue, right, and kind of added them up.
Yes,
right?
yes.
Right. So if you look at the 111 crore, there are three parts to it. There is a pure line haul transportation, there's a pure transportation piece, which is around 60-65%. There is, of course, the network, the physical network, which is the warehouses and everything else. And then there is an overhead and management cost, etc., which is around 10%. The overhead management cost, of course, will not change at all. That's kind of pretty much, I think, at the optimized level. Now, the network cost should not dramatically change. I think we have laid out the network. There'll be some puts and takes which happen as we look at expansion, but those are going to be revenue and growth led. They are not just going to be fixed in nature or going to be intrinsically earnings negating. The key thing for us is to optimize the transportation piece. There's a transportation piece which right now in the transportation, so in both in the warehousing piece, as the volume goes up, it's purely leverage. Right? The operating costs are approximately it's probably around 30% of this, the cost of running the network. Right? The network is probably not going to see a significant amount of cost increases or look to probably around 1.5 to 2 times the current volume. Right? And to that extent, we should be able to run it without adding a substantial amount of cost to that. Right? So that's just pure leverage for us, which is what I think we explained to you earlier as well. I think in an earlier call which was there.
Thanks.
Thank you. Ladies and gentlemen, the line for Mr. Ram has been disconnected. Kindly stay connected while we try to reconnect him. Ladies and gentlemen, thank you for patiently holding. The line for Mr. Ram has been connected. Over to you, sir. So the participant has left the queue. His questions have been answered. We'll move on to the next question, which is from the line of Sumit Kishore from Axis Capital. Please go ahead.
Hi, good afternoon, Ram.
Hi, Sumit.
Just one question. I heard your commentary around the contract logistics business around autos, FMCG, e-commerce. I mean, basically, we have had about 5% or top line growth in first half of the year. One would have expected this business to continue growing at closer to, say, mid-teen levels, more from a medium-term perspective. So is there going to be a pullback to double-digit growth in the second half of the year, or is this more or less the sentiment that is likely to show up in numbers for the full fiscal as well?
I think it's a good question, Sumit. There are a couple of things that I think we are. If you look at the quarter-on-quarter velocity of growth, it's been around 6%. I think last quarter we told you that we did see a bunch of the churn impact coming in. And the focus really is on ensuring that we will get that velocity, to maintain the velocity, right? Order intake has been positive, and therefore we should, I can't call out saying the full fiscal be in the 12 to 15% growth level, Sumit, but if you take out the impact of the Bajaj volume and some of the churn, I think by the end of the year we should be running this, our run rate should be at a double-digit growth level, is what I would expect we will be at. Right? Now, will that be the full fiscal impact? It's hard for me to say at this stage, Sumit. I don't have the numbers except clearly in front of me, but at the run rate level, we should be getting back to a double-digit number. I think equally important is we are trying to maintain stronger commercial discipline as well, Sumit. So that's something which we are trying to ensure we are trying to enforce across. That it is not growth for the sake of growth, and so that's something which we are trying to be cognizant about. So there's tighter pricing we're trying to drive as well, which has some impact on distribution kind of contracts. But to your broader question, run rate should be in the early teens, definitely net of these kind of adjustments by the end of the year.
And with that kind of growth stagger, I know.
I'm sorry to interrupt, Mr. Kishore. Your audio is not clear, sir.
Is it better now?
Sir, may we request you to come to the network area? I mean, like, your voice is breaking.
Hope I am audible.
This is better, sir. Please continue.
Yeah, Suraj, you're fine. Just carry on.
Yeah. No, just on your broader vision, I know it's a vision, but FY26 getting to 100 billion rupees is some recalibration required in light of what we've been seeing on freight forwarding side as well as softer growth so far this fiscal.
Yes, so it's hard to kind of put a specific hold it exactly to a specific thing. I think as you said, what I do feel very good about is we had laid out a vision of around 60,500 crores for the 3PL contract logistics business. We feel we're in a good place to get that over the next 3.5 years, right, on a run rate basis. I think the challenge for us is some of the macros that affected forwarding, like they affected mobility, right? And as those macros get reset, there will be hockey sticks which will come back on the forwarding side as well. So are there upsides which exist? Clearly, we think the upsides do exist. Do I think there's a need for us to right now go back and start reworking those long-term aspirations? No, right? I mean, those aspirations could move a quarter or two here or there. It's about doing the things which will deliver those aspirations, which are important, right? So that it still remains very much a focus. We've not tried to be shy about putting the aspiration out. As you know, we put it out in the middle of COVID. Right, because we believe that that's the potential the sector and our business model offers. Will it move? Can it move a quarter or two here and there? Of course it could. I'm not going to say there are things we still don't know what the next 3 years could happen. Right, there was a COVID effect and so on. But at this stage, I think our focus as a management team is to do the things which will drive that. Right, and to see that's what we've been doing in the contract logistics business. It's kind of now at a run rate, at probably north of 4,000 crores on a run rate basis, between 4 and 4.5 crores on a run rate basis. We feel good about it, build for the grow to 6.5 in the next 3.5 years, right? Similarly, some of the other stuff has to play out, and and the intense focus on getting the leading things done. And when we get the right leading things done, then a couple of quarters here and there to us does not make a big difference. But if we run it just on the markets being favorable, then that probably some stage the markets will move against and the number will not hold. Right? So that's kind of my broad answer. We're not in a hurry to change that number, recalibrate it right now. We'll do it at the appropriate stage. Probably the end of the year we take a strategy review at the end of the year. We'll relook at that point.
Sure. Well, thank you and wish you all the best.
Thank you. Ladies and gentlemen, due to time constraint, this will be the last question for today, which is from the line of Ankita Shah from Elara Capital. And may we request all the participants to limit their questions to 2 per participant. Thank you. Please go ahead.
Thank you. I just have 2 questions, sir. If you can help me with the volume number for B2B Express business for 2Q, and how much do you expect to close this year? By 4Q, 1. And second, how has been the order intake in 3PL business for the quarter versus YOY?
So Ankita, I don't have the exact forwarding volume number, but if you reach out to our team, to SG and our team, we should be able to get that out to you. Don't have it right off the cuff. I know that as I said, our volume did go 3% on a QOQ basis. Sequentially, right? But if you reach out, we'll get you a more specific number. I think on the contract logistics side, volume for the order intake for the quarter was north of 100 crores. So that has been accelerating itself. We had a weak Q3 and Q4 last year, right, because of some of the churn happening. And I think the Q2 last year was very strong. It's kind of in line with Q2 last year. Order intake is in line with Q2 last year. E-com is slightly still lower than Q2 last year. Non-e-com is up. E-com is down. But it's pretty much in line with Q2 last year. But what we find is that the bidding activity is pretty strong right now. So we're pretty confident that Q3 and Q4 will hold. the pipeline is good. Whereas compared to last year, where we saw a fairly big impact in Q3 and Q4 because of some of the churn and the slowdown in e-com space. Okay.
Ms. Shah, does that answer your question, ma'am?
Just one part you missed, I think. For the B2B express business, what level do you think we'll close this year in terms of volume, tonnage?
Yeah, so I think, as I said, our aspiration is to be able to get back to that, to get back the full recovery of the volume loss. So we have under 20-25% growth to go there, Ankita. So that's kind of what, and I think I mentioned earlier in question response to, I think, Alok's first question on express.
Okay, got it. Okay. Great. Thank you so much.
Thank you, ma'am.
Thank you.
Thank you. Ladies and gentlemen, as that was the last question for today, I would now like to hand the conference over to the management for closing comments. Over to you, sir.
Thank you, everyone. I hope we've been able to answer all your questions satisfactorily. However, if you need any further clarifications or want to know more about the company, please do contact our team or SG, our investor relations advisors. On behalf of my colleagues at MLL, I wish you all a very happy Diwali and hope the festive season brings happiness to you and your dear ones. Every year during the festive season, millions of our delivery associates across our industry will call you at home to deliver festive joys. These delivery associates are the backbone of our industry and our celebrations. And I urge you all, if possible, to spend a few minutes spreading kindness to them, providing them a glass of water or some snacks, or just thanking them for the work they do. I think it makes a big difference to our industry. I wish you all a very happy Diwali and a prosperous year ahead. And thank you once again for taking the time to join us during the call today.
Thank you very much, sir. Thank you, members of the management. Ladies and gentlemen, on behalf of Mahindra Logistics Limited, that concludes this conference call. We thank you for joining us, and you may now disconnect your lines. Thank you.